All right. Thank you again for joining us for our Retirement Basics video series. My name is Greg Parker, managing partner here at Engrave Wealth Partners. And today we're going to dive into the potential tax saving strategies available to you in retirement. As we talk about these things, we're going to be reminded of a few of the issues we talked about in earlier videos as to where the tax problem actually comes from. But today I want to speak very specifically to the opportunity of using NUA, or net unrealized appreciation, as a potential tax savings vehicle. As we discuss this, we remind you of the potential challenges that come from having the traditional financial planning problem of too much money in the IRA rollover. Now, I know most traditional financial planners will tell you that you can probably enjoy an extremely low marginal tax bracket for your first few years after retirement, not having to pay much in taxes. The reason for that is they want to convince you that you can live off of non-retirement savings for the first few years and enjoy significantly lower brackets. That would be assuming you have enough assets in the blue after-tax brokerage account or the green Roth IRA account in order to live off of. Any distribution that comes from an IRA rollover, if you recall, is going to be treated as ordinary income. So if you've retired and decided to either leave your money in the Fidelity Savings Plan or roll the money over into an IRA, any distribution that you take from the savings plan or the IRA is taxed as ordinary income, which applies to the marginal bracket system. What we want to talk about today is the potential tax savings that could come from having company stock in your 401k savings plan at Fidelity and understanding the ability to move the company stock out of your savings plan into an after-tax brokerage account. Why does NUA make sense? Why would anybody care about moving their company stock from their savings plan directly into their after-tax brokerage account? Because there is an opportunity to do so at a significantly lower tax rate. By leaving the money in the savings plan in your company stock, that company stock is either going to be sold from your savings plan or your IRA when you need a distribution. Any distribution from there of the company stock is treated as ordinary income. However, if we use NUA, NUA allows you to move the stock from your savings plan to your after-tax brokerage account and only pay taxes on the cost basis. Does NUA make sense to you? Well, in the end, the only reason NUA would work is if you own company stock with a lower cost basis than today's market value. Now, I know that's confusing tax terms, but essentially what I'm saying is if you bought Chevron stock in your savings plan, either through your profit sharing or through other means, you very likely have a cost basis that is somewhat less than today's market value. That's where NUA makes sense. Folks, I've heard financial advisors say for years, as well as some CPAs, that, well, NUA is very confusing. You don't want to mess with it. Let's just move that stock into your IRA, or let's sell it and diversify the portfolio. Before you do that, please make sure to discuss NUA with us to know whether or not it makes sense for you to use NUA. Again, if your original cost basis is less than your current market value, NUA has the potential for some major tax savings. When we talk about the tax problem, remember what we're dealing with. We're dealing with the very idea that your taxes will go higher beginning at age 72, thanks to RMDs. Looking at RMDs in this particular example, the RMD for this individual kicks in 2031, showing a market increase in taxes paid. What's interesting is I haven't changed their income all that much. In fact, in this example, this is someone who wanted to receive $150,000 a year of retirement income with a very modest 2.5% inflation increase. Folks, you can see the dramatic impact of required minimum distributions at 72 with the additional taxes paid beginning in 2031. Does NUA make sense for you? This is where we can dive in and talk very specifically about how NUA works. Why is it a benefit? Simply because you're taking stock from the savings plan, and instead of adding it to the IRA rollover, You're simply moving it into an after-tax brokerage account. Other benefits could exist when having the stock in that after-tax brokerage account, such as the dividends that stock is paying are now considered qualified dividends once it's in the after-tax brokerage account. That means those dividends enjoy a lower marginal tax rate than your other income. Dividends in a qualified account like this would simply be maxed out at a 15% tax, assuming, for most investors, assuming that you're in anything other than the highest marginal bracket. If you happen to be in the highest marginal bracket, dividend taxes max out at 20%. So NUA is simply the decision as to whether or not you should move your company's stock directly from the savings plan into an after-tax brokerage account rather than rolling it into the IRA. Let's walk through an example so that you can know exactly how it works and see how the math looks as it relates to someone from Chevron. As we look at most Chevron employees, it's important to note that you very likely have company stock from two different sources. Number one, your ESOP shares, which for nearly every Chevron person I've ever spoken to has a cost basis significantly less than today's market value. But for many of you, even your common stock shares are going to have tax rates that are or cost basis that are significantly less than today's market value. Folks, the example I've got here is an individual that we actually work with. And this is the representation of her NUA strategy that we put together when she was ready to retire. Looking at her situation, she had 2,839 shares of ESOP shares with a cost basis of only $50,229. Total market value at $160 a share was $454,240. The common stock shares, she had a few more of those, 4,871, but the cost basis on those was still less than today's market value, $375,021. Folks, today's market value for the 4,800 shares at $160 was $779,360. There are some tremendous opportunities for tax savings working with this individual. Let me show you how we looked at it. The very first strategy that we recommended was that she take all of her ESOP shares, 2,839 shares. Now, it seems like a random number to start with. You might say, well, that's because the cost basis was so much lower, but there's yet another reason why NUA makes sense for her at this level. If you'll notice, I overlooked the fact that she also had $47,724 of after-tax contributions. Folks, those after-tax contributions play a very important role when calculating NUA. If you recall, we talked about after-tax contributions as something that is in your 401k savings plan where you have contributed above and beyond the IRS pre-tax limit. If you're not sure whether or not you have after-tax contributions, you can simply look at your fidelity statement. Usually it's down there on page 2 or 3, and it'll have a line item that says post-1986 after-tax contributions. Folks, those after-tax contributions mean that you've already paid taxes on that income. They've been growing inside your savings plan, but these original contributions are useful because the IRS allows you to substitute or swap your after-tax contribution shares with your NUA shares, allowing you to reduce your tax liability on the cost basis. Let me say that again. Essentially, what the IRS lets you do is use your after-tax contributions to reduce the cost basis that you might owe taxes on. So in this case, her 2,839 ESOP shares have a cost basis of $50,229. The after-tax contributions are subtracted from that cost basis, leaving her only $2,505 of ordinary taxable income to report at the time of exercise for NUA. $2,505 at her given tax bracket that year meant that her total taxes due amounted to $551, and she had 2,839 shares with a $454,000 market value in her after-tax account, and it only cost her $550. Folks, that is an amazing opportunity. You will never have the opportunity to take that much money out of your savings plan at one time for that little amount of taxes, that to me is a substantial opportunity for tax savings. Now, I know some of you look at that and go, that's fine, but I don't want to pay any taxes on it. And just to give you an example of how NUA worked, we literally backed down. Instead of taking all 2,839 shares of stock, if we only took 2,650 shares of stock out of her savings plan from the ESOP shares, now she has no tax liability whatsoever. In fact, because the after-tax contributions are higher than her cost basis, she even has a little bit of money left over in her after-tax contributions bucket to roll into a Roth IRA. Folks, again, what a substantial opportunity for tax savings. In this case, still $424,000 tax-free out of the savings plan at the time of NUA exercise. Why do I care so much about evaluating this? Very specifically, if we can avoid going to the IRA altogether and go straight to the blue bucket for after-tax savings, folks, that is a tremendous benefit when we get to age 72. Here's the key, and what I hope you saw in my math. It is extremely nuanced and specific to your personal situation. I cannot emphasize enough how important it is that you look at your specific personal numbers to know whether NUA makes sense, and not only whether it makes sense, but very specifically, how much makes sense. The number one area of mistakes that I have seen when it comes to retirement planning has come from NUA, either in the form of a missed opportunity where somebody didn't take enough shares of NUA, or someone who took too many shares of NUA because the advisor they worked with didn't understand the tax implications, and they ended up with a ridiculous tax bill the first year of retirement. Folks, don't make that mistake. Let us build out the personal analysis for you that shows you the different options you may have to maximize and optimize your NUA options before you actually retire. It's important to do that before you retire because of how NUA works. You must use NUA before you roll the money from your savings plan into an IRA. If you've already rolled the money into an IRA but didn't use NUA, it's too late to do anything about it. You are not able to go back and change that. Let me finish with us here today with a couple of frequently asked questions that I get when we talk about NUA with clients. Number one by far question I get asked is, does this mean I have to sell any of my company stock? The answer to that question is no. The whole purpose is simply moving the stock from one account into another. You will still own the stock in the other account, but there's another benefit of NUA that you may not know about. Any company stock shares that are NUA'd from your savings plan into an after-tax account are now treated for long-term capital gains purposes. And what I mean by that is, if you do decide to sell that stock somewhere in the future, the gain that you have on the stock is going to be a long-term capital gain, not ordinary income. Why does that matter? Because long-term capital gain tax rates are significantly less than most other taxes, especially the marginal brackets. For most of you, your long-term capital gains will not be more than 15% when you sell the stock. And again, unless you happen to be in the highest marginal bracket, in which case it would max out at 20%. Still a significant tax savings. You do not have to sell the stock. You can own the stock indefinitely, passing it on to future generations. That part's up to you. We simply need to move it from the savings plan into an after-tax account. What kind of taxes do I actually owe? Another question I comment here if I use NUA. Folks, this does go back to the ordinary income that we talked about in the earlier videos. Ordinary income to the IRS is the same thing as salary or wages. What that means is that any of the cost basis you recognize from NUA will be recognized as ordinary income in the year that you exercise NUA. That's important because it will be added to any other ordinary income, salary, wages, or otherwise, that applies to your marginal brackets. That's why it's a mistake to take too many shares of NUA. In fact, that's the next question I often get. If NUA is such a great tax benefit, Greg, why would I not NUA all of my company stock? And the simple reason is this: if I had NUA'd that person's entire position in stock, she would have been looking at over $670,000 of ordinary income from the sale of the, or from the transfer of the stock alone, not to mention the other salary she would have received in her year of retirement. It's too much income. resulting in too much tax. Understand this, that when you do NUA, when you exercise NUA and move those shares over, the ordinary income you recognize that year is a result of your total cost basis of stock. We can help you figure out what that is generally by simply looking at the savings plan statement. Well, the last question is regarding the timing of NUA. Do I have to use NUA when I retire, or can I push it off and wait until a later time? The IRS rules are very specific, and they dictate that NUA must be exercised within the calendar year of your first 401k distribution after retirement. What does that mean? Well, it simply means this. Let's say, for example, that you decide to retire, but you're not going to move the money out of the Fidelity savings plan. You're going to leave it there. If you decide to leave it there, if you ultimately need to take a distribution from that 401k for income or any other purpose, that starts a clock with the IRS saying that you have until the end of that calendar year to exercise NUA, or else it's gone forever. Folks, this is an extremely important decision to make before retirement. If you have not looked at NUA before, or if someone's told you not to mess with it because it's complicated, please don't listen to that. It's the perfect time to sit down and answer some of those basic questions, such as, can I even afford to retire? Or how much income can I take off of my retirement savings? And I've heard about your Roth conversions and these NUA strategies. I don't know what any of it means. Folks, we can do that through your personalized retirement analysis. By collecting some basic information from you, we can build out a scenario that shows not only your income abilities, not only what your investment options are, but very specifically a tax plan that you can work on in the first few years of retirement to help manage not just the first few years of retirement taxation, but also taxes that will be due with RMDs. Folks, if you've not taken the chance to do that, I strongly encourage you, go to our website at engravewealth.com. Click on the Start Your Free Retirement Analysis button. We'll collect some basic information, and we'll look to schedule a time to visit with you about your retirement analysis. There's no cost, there's no obligation, there's no contracts to sign. We will simply build out that analysis and share it with you over a Zoom meeting or in person here at our office. Either way, we can put in your hands the tools you need to make the best decisions for your family on how to manage those retirement decisions. Folks, don't hesitate. This is a great time to do it. Stay tuned. I've got future videos coming up on Roth conversions and what this plan looks like. We'll be more than happy to make those available. I hope you have a great day.